Welcome to the introduction of Pasture, Rangeland, and Forage Insurance, or the PRF program. Throughout this video, we'll discuss what PRF insurance is, how it works, and how producers can use it as part of their overall risk management strategy. We'll also cover some of the most important decisions producers make when purchasing a policy, including selecting coverage intervals, choosing a coverage level, and understanding productivity factors. By the end of this video, you should have a solid understanding of how the program functions and whether it may be an appropriate risk management tool for your operation. Drought is one of the greatest sources of production risk for livestock and forage producers. Reduced rainfall often means reduced forage production, forcing producers to purchase additional feed, reduce stocking rates, or sell livestock earlier than planned. PRF was developed to help manage that risk. It's important to recognize that PRF is designed as a risk management tool. Like any insurance policy, its purpose is to help reduce financial losses, not guarantee a certain income each year. PRF relies on a rainfall index that represents precipitation across the entire grid where your insured acres are located. If rainfall within that grid falls below its historical average during the coverage interval you selected, the policy may trigger an indemnity payment. This means payments are determined using objective weather data, instead of measuring forage production directly in the pasture. When enrolling in PRF, producers make several important decisions. First, they'll decide how many acres they want to insure. Next, they select a coverage level that determines how sensitive the policy is to rainfall shortages. And finally, they'll choose the 2-month intervals that are most important for forage production on their operation. One unique aspect of PRF is that producers never have to prove their forage actually suffered a loss. If the rainfall index for the insured grid falls below the selected trigger level, payments will automatically occur. In order to understand how PRF works, it's essential to understand rainfall grids. To evaluate actual drought levels experienced, the entire country is divided into geographical grids. In Idaho, these grids are approximately 1/4 degree by 1/4 degree, which is generally around 17 miles by 17 miles, although the exact dimensions vary slightly depending on location. Every insured acre belongs to one of these rainfall grids, and the rainfall measured for that grid, not your individual rain gauge, determines whether a payment is triggered. This creates a concept in PRF known as basis risk. For example, your ranch may receive adequate rainfall while much of the surrounding grid remains unusually dry. In that situation, the grid rainfall index may fall low enough that you receive an indemnity payment, even though your individual operation experienced relatively normal conditions. The opposite can also happen. Imagine your ranch receives very little rainfall, but the rest of the grid receives enough moisture to remain close to average. Because the grid did not experience a rainfall deficit, no payment would be triggered. You may wonder how the NOAA develops these rainfall estimates. Instead of relying on single weather stations, the NOAA combines information from several sources. Ground-based weather stations continuously measure precipitation across the country. Satellite observations provide additional information, especially in remote areas. Computer models then combine these data sources to estimate rainfall across the landscape. And finally, rainfall estimates are assigned to each PRF grid. This approach allows rainfall to be estimated even in locations where there are few or no nearby weather stations. This illustration helps visualize that process. Each grid receives rainfall estimates based primarily on the 4 weather stations closest to its center. Stations located nearest to the middle of the grid receive the greatest weight in the calculation, while stations farther away contribute less. Using multiple reporting stations instead of relying on a single rain gauge creates more stable and consistent rainfall estimates across a large geographic area. Unlike programs that insure an entire growing season, PRF divides the year into 2-month coverage intervals. When purchasing a policy, producers choose which of these intervals they want to insure. One important rule is that overlapping intervals cannot both receive coverage. This prevents producers from insuring the same month twice. Because every operation has different forage growth patterns, selecting the right intervals is one of the most important management decisions under PRF. As you can see, each month has 2 intervals that are open for coverage. Here, May is included in both the April-May interval and the May-June interval. Choosing one or the other would be fine. However, in this selection, May would effectively be insured twice, and this is not permitted under PRF rules. Any overlapping intervals like these must be avoided when designing a policy. Here, however, the producer selected coverage in the May-April interval and the June-July interval. Since these two intervals do not share a month, this is considered a valid coverage decision. Different operations may choose very different interval combinations, depending on climate, forage species, and management practices. Remember, the goal is simply to ensure the periods that matter most for your operation's forage production. Let's consider an example. Imagine a producer near Twin Falls managing 1,500 acres of native rangeland and introduced cool season grasses. Most forage growth begins during March and April, as temperatures warm and spring moisture becomes available, while peak forage production generally occurs during May and June. During July and August, however, growth often slows dramatically because of hot, dry summer conditions. Then, if fall participation returns, September and October can provide valuable regrowth and extend grazing opportunities. Knowing those seasonal growth patterns helps determine where insurance provides the greatest value. Because most forage production occurs during spring greenup, peak growth, and fall regrowth, this producer chooses to insure March through April, May through June, and September through October. Notice that they avoid placing much coverage on July and August. Although July and August are often dry, the grasses are already largely dormant by that time, so additional rainfall may have relatively little effect on annual forage production. As we know, rainfall only has value when plants can actually use it. If drought occurs during any of these months, it has a much larger economic effect than during already dry periods. Remember to focus coverage on the periods when precipitation has the greatest influence on your operation's forage growth. The next decision a producer has to make is selecting their coverage level. PRF offers coverage levels ranging from 70 to 90%. Lower coverage levels require larger rainfall deficits before a payment occurs, but they generally have lower premiums. A higher coverage level provides greater protection because payments begin after smaller rainfall shortages. However, that additional protection also comes with higher premium costs. Choosing the right coverage level requires balancing cost with the amount of protection that your operation needs. In addition to selecting a coverage level, producers also choose a productivity factor. The productivity factor adjusts the dollar value of the acreage being insured. Producers may select anywhere from 60% to 150% of the county base value. We will cover exactly what county base value is in the next video. Operations with more productive land, higher input costs, or more valuable forage often choose higher productivity factors to better reflect the value of their production. If your land consistently produces less forage than the county average, selecting a productivity factor below 100% may be appropriate. Doing so decreases both the amount of insurance protection and the premium cost. This option may fit operations with lower producing rangeland or areas where forage yields are consistently below average. A productivity factor of 100% represents land that performs around or at the county average. These operations generally experience average rainfall, average soil productivity, and forage production comparable to neighboring ranches. For many producers, 100% serves as the baseline starting point when selecting coverage. Some operations consistently produce substantially more forage than surrounding land. Examples include irrigated pasture, highly fertilized hayground, or operations using improved forage varieties and intensive management. Because these acres produce more value, producers may choose a productivity factor greater than 100% to increase the amount of insurance protection purchased. In Idaho, several situations may justify selecting a higher productivity factor. These include irrigated pasture, improved forage species, fertility programs that consistently increase production, operations that routinely outperform neighboring ranches, or grazing systems capable of supporting higher stocking rates. Ultimately, the productivity factor should reflect how productive your operation is relative to the county average. This concludes our introduction to the Pasture, Rangeland, and Forage Insurance Program. In the next section, we'll shift from understanding how the program works to examining how indemnity payments are actually calculated.